Hello, my name is Clive Corcoran and welcome to my YouTube channel. In this video, I want us to look at the footprint of exchange traded funds, ETFs, in the global capital markets. So let's have a look at the slide on the screen now, which shows the assets under management for global ETFs as of October of 2024. And we can see a timeline here stretching from 2006 up until October 24. And there has been a very steady increase in the number of ETFs and also the assets under management. So as of October 24, we can see there were more than 11,000 separate ETF products, and with a total AUM of more than $14 trillion, $14.25 trillion. And that has shown a steady rise, as can be seen here. The only period when there was actually a drop was from 21 into 22, and that was simply the result of very adverse market conditions in 2022. So the value of the assets under management dropped quite considerably, but as you can see, this has been more than recovered in the last 2 years shown on the diagram. As can be seen over here, BlackRock has 2.6 trillion under management at with 33%, roughly a third of the market. Vanguard slightly less. State Street, which I'm going to come on and talk about in a moment, has about 1.2 trillion, and I won't read them all out, but you can see these are all the big US ETF issuers, and to a large extent, the US marketplace is still by far the largest market for ETFs. So the diagram over on the left-hand side, as of the end of 21, shows you that the fees, the expense ratio in effect for ETF products, is minimal and has been in decline, although it appears now that this may well have bottomed out down here. So in the US, we can see fees of somewhere around 15 basis points. Down here it mentions that State Street even cut the price tag for 2 of its bond funds all the way down, in one case, to 3 basis points. Some evidence suggests that the fees have bottomed and are starting to move slightly higher, but it is a very competitive landscape, and I would be surprised to see these fees move up significantly from where they are here. Now, the importance of fees or expenses is illustrated on the diagram on the right. Now, what this shows is the impact of fees on long-term returns when we are compounding growth rates. So if we start here, let's say at year 1, and we move all the way out to year 30, if we have a 5% growth rate and we compound it over 30 years with a starting principal of £10,000, it can clearly be seen that with very minor fees, annual fees, let's say 25 basis points, 10,000 grows to £40,000 over 30 years, whereas let's supposing we are down here with annual fees, say, of 4%, eroding obviously this rate, then £10,000 only in fact rises to around £13,000. So one of the great advantages for ETF investors is that because the fees are so minimal, they do get the more or less the really significant benefit of compounding growth. One theme that's been evident in the last several years is an increasing focus on what are called thematic ETFs. Now, these are essentially actively managed products, actively managed funds. And even though as of November 24, this is still a relatively minor part of the overall AUM that we saw just a few moments ago, we can see there are 1,400 thematic ETFs with assets under management of somewhere around $320 billion. So now let's talk a little bit about these active ETFs, or thematic as on the last slide. they are required to reveal their holdings, their actual assets that they are holding on a daily basis. According to the SEC, actively managed ETFs are required to publish their holdings daily because there is no index that can serve as a point of reference. Publishing the specific holdings allows the arbitrage mechanism to function. The arbitrage mechanism has to do with the tracking or minimal actually tracking error between what the performance of the fund, which holds various assets, is doing with respect to the underlying benchmark, let's say some kind of an index like the S&P 500 or the FTSE. Mandated disclosures may actually be a disincentive for some ETF providers to launch actively managed ETFs. You can see the quote down here. I won't read it out. Now let's take an example of a thematic ETF. This one is known as the ARK Innovation ETF. It trades under the symbol ARKK in the United States. And let's read what it says. One of the most popular actively managed ETFs is from ARK ETF Trust. They have actually a number of ETFs. This is a stable, if you like, of ETFs. The investment seeks long-term growth of capital, and the fund will invest in domestic and foreign equity securities of companies relevant to the fund's overall investment theme of disruptive innovation. Now, the fund has been around since 2015, and as of June 25, the NAV, net asset value, is 60 billion, and it has an expense ratio of 75 basis points. Now, let's actually have a look at how this particular fund has performed, and I'm going to focus on this time period here, starting in 2020. This, of course, is the onset of the pandemic in the first quarter, and as can be seen, the performance then actually is quite extraordinary. The fund moved all the way from down here around $40 or whatever it was, all the way up to $160 at the latter part in the latter part of 2021. And at that point, it then took a nosedive and came all the way back down. And when I put this chart together back in March of this year, the closing price was $51.50, which is almost identical to what it had been 5 years prior at the end of April of 2020. Now, the other diagram on the screen shows you the relative performance of the ETF, this one, the ARK fund I just mentioned, versus the performance over a 2-year horizon for Berkshire Hathaway. This is the fund that Warren Buffett has managed and is a major shareholder of. And as can be seen, starting from here, which is when the extraordinary rise took place, and up until the first quarter of 22, the fund actually delivered more or less exactly the same return as the more conservatively run fund Berkshire Hathaway did during the same period. A leveraged ETF enables the amplification of gains and losses from the performance of some underlying index or asset. So, for example, there is a fund, we'll see it in a moment, the ProShares Ultra, which is designed to return twice the daily performance of the underlying S&P 500. It does this by incorporating derivatives, such as futures contracts, that provide leveraging of returns of the index. However, leveraged ETFs are designed to replicate the performance, in other words, deliver the twice return, only over a single day horizon. They have significant tracking errors over time. And also, as you'll see in a moment, since these funds use synthetic replication techniques, they also involve counterparty credit risk. For example, the derivatives counterparty, let's say it's based on a swap providing the leverage, might then default. This must be clearly notified to all investors as a significant risk disclosure. Here we can actually see the fund I just mentioned, and you can see the leveraged fund seeks a return twice the return of its underlying benchmark. Due to the compounding of daily returns, if you hold this for anything other than 1 day, the performance will differ in not only amount, but also even possibly direction from the target return, the twice return or twice daily return of the S&P 500. So let me now explain what the restriction there to the single day horizon, how it arises. So compounding of returns creates tracking problems for leveraged ETFs. Leveraged fund providers can achieve their stated return performance only over a single day horizon, and prospectuses must make it perfectly clear that this is the case. So here's the example. Let us consider an ETF providing twice the leverage to the underlying. Well, we just looked at one on the last slide. Assume on the first day the index goes up by 10%. That's the cash index. And the next day it falls 10%. Now that might seem rather extraordinary. It is. It doesn't happen frequently. It, for example, did happen back in 2020. But it's actually, the magnitude is not vital. It simply helps to illustrate the point. The 2-day loss for the actual cash index is 1%, but the loss for the leverage fund, the one we just talked about, is actually 4%. Here's the explanation. So the actual cash index goes 1 plus 10% first day, multiplied by 1 minus 10% on the second day, which is 1.1 multiplied by 0.9, which is 0.99, effectively a 1% loss for the cash index. The leveraged fund goes up 1 plus 20% on day one, down 1 minus 20% on the second. We have 1.2 multiplied by 0.8, which resolves to that, which is actually a 4% loss. So over the 2 days, the fund's losses are 4 times the amount of the actual cash index, not the 2 times. There are also inverse ETFs. And the idea here is that you go long an ETF, in other words, you buy the ETF, but the ETF structure is effectively short whatever the underlying, say, index is. So let's suppose you are bearish on the US benchmark. You can purchase an ETF which trades under the symbol SH. This returns the inverse return of a long position in the S&P, but is designed to achieve this again only on a daily basis. We've discussed the tracking error issue. Okay, so thanks very much for watching. I hope you found that material to be interesting and useful, and might I suggest that you decide to subscribe, if you're not already a subscriber, to my YouTube channel, the Corcoran Codex. I am adding material on a regular basis, and I look at different critical ideas and episodes in the world of finance.